Welcome to the Deep Dive. Today we're cutting through the complexity of something that touches every single one of us, yet often feels like a dense, complicated maze: our taxes. But don't worry, because this deep dive is designed to be your expert guide, demystifying the numbers and empowering you with real, actionable knowledge. Let's unpack this.
Yeah, let's do it.
We're plunging headfirst into the intricate world of individual ordinary income tax calculations, the surprisingly generous array of tax credits available, and even how things like estimated taxes and other special taxes play into your overall financial picture.
That's exactly right. Our mission today is to extract the most important nuggets of knowledge from the sources you've shared with us on tax computations and credits.
Okay.
Think of it as a shortcut to being well-informed, giving you a clear path to understanding how these seemingly disparate pieces fit together.
A shortcut sounds good.
And I promise you, we're going to uncover some surprising ways the system works, especially how certain credits can genuinely put money directly back into your pocket. It's not just about what you owe. It's truly about what you might get back, or even, strategically plan for.
Absolutely. So let's kick things off by tackling a fundamental misconception about how individual income is taxed. Many people, and I mean many people, assume their income is taxed at a single flat percentage.
Right.
You hear things like, oh, I'm in the 24% tax bracket. But the truth is, that's rarely, if ever, the case for your entire income.
Not at all.
We're going to show you exactly how it actually breaks down and why understanding this progressive system is so crucial for any smart financial decision.
It's truly a cornerstone of our tax system. The United States employs what's called a progressive tax rate structure for individual ordinary income.
Okay, progressive.
What this means conceptually is that as your taxable income increases, the marginal tax rate applied to those higher increments of income also increases. For 2023, for example, these ordinary income tax rates start as low as 10% and go up through 12, 22, 24, 32, 35, and finally 37%.
Quite a range.
It is. And what's particularly fascinating is how significantly the income thresholds for each of these rates change based on your filing status. This isn't a one-size-fits-all system.
So it's not just your income level, but how you file, whether you're single, married, or head of a household, that determines which slices of those percentages apply to which portions of your earnings. That sounds like a significant difference.
It is, and it's a difference that can dramatically impact your final tax bill. For instance, for a single filer, that initial 10% rate applies to taxable income from $0 up to $11,000.
Okay, the first 11 grand.
Right. But if you're married filing jointly, that same 10% rate stretches much further, covering income from $0 up to $22,000.
Ah, double. Interesting.
You see how the width of these initial tax buckets doubles for married couples. The thresholds for hitting higher rates are generally expanded for married couples filing jointly and also adjusted for head of household filers and those married filing separately.
So that filing status really matters.
Understanding your filing status isn't just a box you check on a form. It's the first step to knowing your actual tax liability and how your income is fundamentally treated.
That's a great point, because it means the same dollar amount of income can lead to a very different tax bill depending on your household structure. And just to really cement this concept of a progressive tax rate structure, what we mean is that your tax rate isn't fixed across all your income. Instead, your income's divided into tiers or brackets, right?
Exactly, tiers or brackets.
And each tier is taxed at a different rate.
Right.
You're never taxed at your highest bracket's rate on all your income, only the portion that falls within that specific bracket.
Precisely. You only pay the higher rate on the income in that higher bracket. And this leads us to the concept of the marginal tax rate.
Okay, the marginal rate.
This is perhaps one of the most misunderstood terms in personal finance, but it's absolutely essential for making smart financial decisions. The marginal tax rate is simply the rate applied to the next dollar of incremental taxable income you earn.
The very next dollar.
Yes. So if you're considering taking on an extra project, earning a bonus, or making a new investment, the tax on that additional income is calculated at your marginal rate, not necessarily your average tax rate across all your earnings. It's the rate that matters for your future earnings decisions.
Okay, here's where it gets really interesting, I think. Let's walk through a real-world calculation to bring this to life, using those 2023 rates we just discussed. This will make it crystal clear why that single percentage idea is so misleading.
Good idea. Let's do it.
Imagine you're a single taxpayer with $100,000 in taxable income. Many might mistakenly think, okay, I see $100K falls in the 24% bracket for single filers, and therefore assume they owe $24,000. But let's break it down, slice by slice, using the specific brackets for a single filer.
All right.
First, the lowest slice. The first $11,000 of your income is taxed at 10%. That's $1,100.
$1,100, got it.
Next, the income from $11,001 up to $44,725. That chunk is taxed at 12%. That difference is $33,725 times 12% gives us $4,047 in tax to that part.
Okay, $4,047 for the 12% bracket.
Then the income from $44,726 up to $95,375 is taxed at 22%. So that's a range of $50,650 times 22%, another $11,443.
Right, $11,143 there.
Finally, the remaining portion of your $100,000 income, which is the amount over $95,375, that's $4,610.
Just that last little bit at 24%.
Exactly. Now we add up all those pieces, $1,100 plus $4,047 plus $11,143 plus $1,110. Your total tax liability for $100,000 of taxable income as a single filer is $17,400.
It's a huge difference. It's a powerful illustration of how only a portion of your income is taxed at that highest rate you might hear about. And that concept applies across all filing statuses. You know, if we consider a head of household taxpayer with $60,000 of taxable income, using their specific brackets, their total tax liability would come out to $6,911.
$6,911 for a head of household at $60K.
Right. Or take a married couple filing jointly with $75,000 in taxable income. Using the MFJ brackets, their tax bill would be $8,560.
$8,560. So quite a bit lower tax for the same income compared to single, even though the income is higher than the head of household example.
Exactly. You can already see how beneficial the married filing jointly status can be for certain income levels thanks to those wider tax brackets.
Makes sense.
And even a married taxpayer filing separately with $50,000 of taxable income would pay $6,307.50 using their own less favorable brackets.
Okay.
Each scenario highlights how the progressive system works by taxing different layers of income at different rates, rather than a flat percentage on the whole amount.
That's incredibly helpful for wrapping your head around the mechanics. It really underscores why understanding these progressive rates is key. So to reinforce the marginal tax rate concept, let's consider Mark, who's married filing jointly. His taxable income is usually $75,000, which means his tax liability is that $8,560 we just mentioned. What if Mark unexpectedly gets an extra $15,000 bonus, bringing his total taxable income to $90,000? How does that additional $15,000 get taxed, and what does it tell us about his marginal rate?
That's a fantastic real-world scenario.
Yeah.
So first, we need the total tax liability for Mark at $90,000, using the married filing jointly brackets again.
Right.
The first $22,000 is at 10%, $2,200. The next chunk, up to $89,450, is at 12%. That's $8,094. Then the small amount over $89,450, just $550, falls into the 22% bracket, adding $115.
Okay.
So the total tax at $90,000 would be $2,200 plus $8,094 plus $121 compared to the change in income.
$10,415 total tax.
Okay.
Now, to find the marginal tax rate on that additional $15,000 bonus, we look at the change in tax compared to the change in income. The tax bill went from $8,560 for $10,450. That's an increase of $10,855.
Exactly, $8,855. Divide that by the additional $15,000 of income, and you get approximately 12.4%.
12.4%. So that's his marginal rate on the bonus.
That's his marginal tax rate on that bonus. What's crucial to note here is that even though his total income of $90,000 crosses into the 22% tax bracket, the overall marginal rate on that additional $15,000 is only 12.4%.
Why is that?
Because most of that $15,000 increase still fell within the lower 12% bracket. Only the very top portion, that last $550, was taxed at 22%. So don't let the fear of hitting a higher tax bracket stop you from earning more. Often the net benefit is still very much in your favor.
Ah, that makes perfect sense.
This understanding empowers smarter financial decisions about extra income.
That really clarifies it. It's about understanding how each additional dollar is taxed, not your whole income. And speaking of different rates, it's important to remember that not all income is treated equally. Certain types of income benefit from what are called preferential income tax rates.
Yes, precisely. Specifically, long-term capital gains.
Which are?
Profits from selling assets like stocks or real estate held for over a year.
Got it. Over a year.
And qualified dividends, which are certain dividends from stocks, are often taxed at these preferential rates. For 2023, these rates can be 0%, 15%, or 20%.
0%, wow.
Yeah, for lower income levels. And these are generally much lower than your ordinary income tax rates. And just like with ordinary income, the income thresholds for these preferential rates vary significantly based on your filing status.
So the system actively favors certain types of income.
You could say it incentivizes long-term investment, for example, by taxing those gains at lower rates than, say, wages. It highlights that the tax system has different rules for different types of income, not just different levels of income.
Okay, so we've talked about how your income gets taxed.
Right.
Now let's transition to something that often feels even more like magic for taxpayers. Tax credits.
Ah, yes, the credits.
If deductions reduce the size of the pie that's taxed, credits are like powerful coupons that take money directly off your final tax bill, dollar for dollar.
Right.
They're incredibly impactful.
That's a perfect analogy. A deduction reduces your taxable income, which in turn reduces your tax by a percentage, your marginal rate, actually.
Right.
A credit, however, directly reduces the amount of tax you owe. $1 of credit saves you $1 of tax. There are two basic types to be aware of: non-refundable and refundable.
Okay.
And knowing the difference is key to understanding their power.
Let's start with the non-refundable personal tax credits. These are credits that can reduce your tax liability down to zero, but they won't result in a cash refund back to you if the credit amount exceeds your tax bill.
Correct.
Think of them as helping you pay your bill, but not giving you extra cash if your bill is already zero.
Exactly. Examples of these valuable non-refundable credits include portions of the child independent care credit, the credit for the elderly and permanently disabled, most education credits like the lifetime learning credit,
Okay.
the retirement savings contributions credit, often called the Savers credit, the foreign tax credit, the general business credit, and the adoption credit.
That's quite a list.
It is. And while they don't generate a refund, they are still incredibly valuable because they directly reduce the tax you would otherwise owe. Knocking it down to zero is still a great outcome.
Absolutely. And then we have the refundable credits. These are the true powerhouses for many taxpayers because they can result in a cash refund, even if you had no tax withheld from your wages, or if the credit amount exceeds your entire tax liability. These are the credits that can literally put money back in your pocket, regardless of your initial tax liability.
Absolutely. Key refundable credits include portions of the child tax credit, the earned income credit, any federal income tax withheld from your W-2 form, which is basically a prepayment you made,
Right.
excess Social Security tax paid, and a portion of the American Opportunity Tax Credit for education. For many low and moderate income families, these refundable credits are absolutely essential, providing a significant financial boost and acting as a vital safety net.
Okay, now let's dive into some of the most commonly used and impactful tax credits, starting with the Child Independent Care Credit. This one directly helps working families.
It does. This credit is designed to help taxpayers with work-related expenses for the care of qualifying individuals.
Work-related expenses.
Okay. It's a percentage ranging from 20% to 35% of those eligible expenses. The maximum expenses you can claim for this credit are $3,000 for one qualifying person and $6,000 for two or more.
And who exactly is a qualifying person for this credit? Is it just young children?
Primarily, yes. A qualifying person can be a dependent child under the age of 13 when the care is provided.
Under 13.
But it can also be a disabled dependent of any age who is unable to care for themselves and meets the support test, meaning you provide more than half of their support.
Okay, that's broader than I thought.
And importantly, it can also be a spouse who is disabled and unable to care for themselves.
Wow, okay.
Generally, for married taxpayers, both individuals must have earned income to be eligible, unless one spouse is a full-time student or incapacitated. The expenses must be incurred for the purpose of enabling the taxpayer to be gainfully employed. Meaning it allows them to work or look for work. That's the key link.
So things like a babysitter, nursery school, or daycare would qualify, but not, say, elementary school tuition, correct? The goal is care, not formal education.
That's spot on. The purpose is care that enables employment, not general education expenses. Eligible expenses explicitly include babysitters, nursery school, and daycare, but exclude things like elementary school tuition.
Got it.
The actual credit amount depends on your adjusted gross income, or AGI. The percentage starts at 35% for those with AGI of $15,000 or less, and then it phases down by 1% for every $2,000. Your AGI is over $15,000.
Okay, so it phases down.
Until it hits a minimum of 20% for anyone with AGI over $43,000. So for many average income earners, the rate will be 20%.
So 20% of up to $6,000 in expenses if you have two kids?
Yeah.
That's $1,200.
Exactly. Up to $1,200 for two or more dependents, or $600 for one dependent if you're in that 20% range. It's a direct reduction.
Let's illustrate with an example. Joanne Vega is a widow with two dependent children. Her AGI is $50,000, so her applicable credit rate is 20%, right?
Correct. Over 43K AGI, so 20%.
She incurred work-related expenses of $3,600 for a home caregiver and $3,800 for childcare at a nursery school. What's her credit?
Okay, Joanne's total qualifying expenses are $3,600 plus $3,800, which sums up to $7,400.
$7,400 total spent.
Right. However, for two or more dependents, the maximum allowable expense for the credit calculation is capped at $6,000.
So she can't use the full $7,400.
Correct. We use the lesser of her actual expenses, $7,400, or the maximum limit, $6,000. So we use $6,000.
Okay.
Since her AGI is $50,000, her rate is 20%. Therefore, $6,000 multiplied by 20% equals $1,200.
$1,200.
Joanne can claim a $1,200 child care credit, directly reducing her tax bill. It's a very tangible benefit for working parents.
That breaks it down beautifully, showing the direct impact. Now, moving on to another significant credit, the credit for the elderly and/or permanently disabled. This sounds like it could be a real lifeline for some.
It absolutely can be. This is a credit of 15% of eligible income for individuals who are either 65 years of age or older.
Okay, 65 plus.
Or are under age 65 but retired due to a total and permanent disability and received taxable disability income for the year.
So two paths to eligibility.
Right. There's a base amount of income used to calculate this credit, which varies by filing status. For instance, it's $5,000 for a single person. It can go up to $7,500 for married couples filing jointly if both qualify.
A base amount, okay.
This base amount is then reduced by any Social Security payments received.
So Social Security reduces it.
Yes, dollar for dollar. And it's also reduced by 1/2 of the taxpayer's adjusted gross income that exceeds certain thresholds. These thresholds are pretty low, $7,500 for single, $10,000 for married filing jointly.
So it phases out pretty quickly with higher income.
It does. The final calculated amount after these reductions is what gets multiplied by 15% to determine the credit. And it's non-refundable, so it's limited to the amount of tax you actually owe.
Let's consider Peter, single and 68 years old. His income includes Social Security, $3,120, some taxable interest, $250, taxable retirement distributions, $3,600, and some part-time wages, $4,245. How would his credit for the elderly be calculated?
Okay, first we need Peter's adjusted gross income from his taxable sources. That's the wages, retirement distributions, and interest. $4,245 plus $3,600 plus $215, $8,060.
$8,060 AGI.
Got it. Now we start with his base amount for a single person, which is $5,000.
$5,000 base.
We then subtract his Social Security income of $3,120.
Okay, leaves $1,880.
Correct. Crucially, we also subtract half of his AGI that exceeds the $7,500 threshold for single filers. His AGI, $8,080, is $560 over the threshold. Half of that is $280.
So subtract another $280.
Right. So from the $5,000 base, we subtract $3,120 and $280, leaving $1,600.
$1,600 eligible amount.
Exactly. Multiplying that $1,600 by 15% gives Peter a $240 credit.
$240.
Okay. Every step matters here, and it's important not to overlook any of the reductions before applying the rate. It's a calculation-intensive credit.
That's incredibly detailed and really helps illuminate how those calculations work. Next up, a big one for many families, education tax incentives. These are complex because there are several, and you need to know which one applies to your situation.
Absolutely. The main ones are the American Opportunity Tax Credit, the Lifetime Learning Credit, and then there are savings vehicles like Coverdell Education Savings Accounts and Section 529 Qualified Tuition Programs.
So credits and savings accounts.
Right. And it's crucial to pick the right one, as you generally can't double dip for the same expenses using different incentives.
Let's start with the American Opportunity Tax Credit, AOTC. What's the story there?
The AOTC is arguably the most generous education credit, but it has specific requirements. It's available for qualified tuition, fees, and course materials, including books.
Books count. That's good.
Yes, books and required supplies. It's for a student's first 4 years of post-secondary education, so think undergraduate studies.
First 4 years only?
Right. The maximum credit is $2,500 per student. This is calculated as 100% of the first $2,000 of qualified expenses, plus 25% of the next $2,000.
Okay, so you need $4,000 in expenses to max it out at $2,500.
Exactly. This credit is powerful because it's on a per-student basis, meaning you can claim it for yourself, your spouse, or your dependent, as long as the student meets the criteria, including being enrolled at least half-time.
Per student halftime. Got it.
And a key feature here is that 40% of it is refundable, up to $1,000 per student.
Refundable. So even if you owe no tax, you might still get up to $1,000 back as a refund.
That's right. It's a significant benefit. It does phase out for higher earners, though. For 2023, the phase-out starts at a modified AGI of $80,000 for single filers and $160,000 for married filing jointly.
Okay, so income limits apply.
Yeah.
And how does that compare to the Lifetime Learning Credit, LLC?
The LLC is much more flexible in terms of academic level and duration. It's available for an unlimited number of years.
Unlimited years. Interesting.
Yes, and for a broader range of courses, undergraduate, graduate, professional degree courses, or even just courses taken to acquire or improve job skills, you don't need to be pursuing a degree or be enrolled half-time.
More flexible eligibility.
Definitely. The credit is 20% of qualified expenses, up to a maximum of $10,000 in expenses per tax return. This leads to a maximum credit of $2,000.
So 20% up to $2,000 max. What's the key difference in expenses compared to the AOTC?
A key difference. Qualified expenses for LLC include tuition and required course fees, but not course materials like books or supplies, unlike the AOTC.
No books for LLC.
Correct. Also, this credit is on a per-taxpayer basis, not per student. So regardless of how many students you have incurring expenses on your return, the maximum LLC credit you can claim is $2,000 total.
One limit per tax return.
It also phases out for higher earners at the exact same modified AGI levels as the AOTC. 80K, 90K for single, 160K, 180K for married, filing jointly in 2023.
So same phase-out ranges. And you mentioned you can't double dip. You can't claim both credits for the same student in the same year, right?
That's correct. You have to choose one or the other for a particular student in a given year. But you can claim different credits for different students in the same year.
Okay. So you could claim an AOTC for one child in college and maybe an LLC for another child taking a single graduate course.
Exactly. Or an AOTC for a dependent child and an LLC for yourself if you're taking courses. That allows for some strategic planning depending on the family situation. This distinction is vital.
Makes sense. Now, beyond credits, there are also savings vehicles like Coverdell Education Savings Accounts. What are those?
Coverdell ESAs are basically investment accounts designed for education savings. Contributions are not tax deductible, and they're limited to $2,000 annually per beneficiary, the student who must generally be under 18 when the contribution is made.
$2,000 limit, non-deductible. What's the benefit?
The benefit is that the earnings inside the account accumulate tax-free, and distributions or withdrawals are also tax-free if they're used for qualified education expenses.
Qualified expenses. What does that include?
For Coverdell, it's quite broad. It includes qualified elementary and secondary education expenses, as well as higher education expenses. So tuition, fees, tutoring, books, room and board, supplies, equipment, even for K-12 in some cases.
K-12 too. That's flexible.
It is. There are income phase-outs for making contributions, though. For 2023, it was 95K, 110K AGI for unmarried filers, and 190K, 220K for married filers.
Income limits on contributing again.
Yes. And any money left in the account when the beneficiary turns 30 typically has to be distributed and might be subject to tax and penalties, but it can usually be rolled over tax-free to another eligible family member's Coverdell account.
Okay. And can you use Coverdell funds and claim an education credit like AOTC or LLC?
You can, but not for the exact same expenses. You can't pay for $4,000 of tuition with Coverdell funds and then also claim the AOTC based on that same $4,000. You need to coordinate the benefits.
Avoid the double dip. Got it. And then we have Section 529 Qualified Tuition Programs, QTPs, which are very popular. How do they differ?
529 plans are state-sponsored programs, often seen as the primary vehicle for higher education savings. You can either purchase tuition credits for future use at specific schools or, more commonly, contribute cash to an investment account similar to a Coverdell, but with much higher contribution limits.
Higher limits, state-sponsored.
Right. Contributions aren't federally deductible, though some states offer a state tax deduction or credit. Like Coverdell, earnings grow tax-free and distributions are tax-free if used for qualified higher education expenses.
What counts as qualified for a 529? Is it as broad as Coverdell?
It traditionally focused on higher education. Tuition, fees, books, supplies, required equipment, and reasonable room and board if the student was enrolled at least half-time. Recent changes also allow some limited use for K-12 tuition and even apprenticeship programs or student loan repayment adding flexibility.
Okay, so 529s are primarily for higher ed, but gaining some flexibility. Any income limits for contributing?
Generally, no federal income limits for contributing to a 529 plan, which is a major advantage over Coverdell's for higher earners. Contribution limits are usually very high, often hundreds of thousands of dollars per beneficiary, varying by state plan.
Big difference there.
Huge difference.
So what does all this mean for you, the listener? It means there are many ways the tax code tries to lighten the load for educational pursuits. Beyond the major credits and savings accounts we just detailed, our sources even mention other ways the tax system provides relief for education. Things like excluding interest from U.S. savings bonds, if used for education.
Right, under certain conditions.
Or if your employer helps pay for your education, that might be excluded from your income. Scholarships used for tuition and books are generally tax-free.
Yes.
And there are even some deductions taken above the line to arrive at AGI, like the educator expense deduction for teachers or the student loan interest deduction.
That student loan interest deduction is a big one for many people.
It really adds up. It's a comprehensive set of incentives designed to make education more accessible.
Definitely a lot of options to consider there. Shifting gears a bit, let's talk about the adoption credit. This is a non-refundable credit for qualifying expenses of adopting a child, which can be substantial.
How substantial?
For 2023, the maximum credit allowed was a significant $15,950 per eligible child. That's based on qualified adoption expenses paid.
$15,950. That's a large credit. And it's non-refundable, you said.
Correct, non-refundable. But if the credit is more than your tax liability in the year you claim it, you can carry any excess credit forward for up to 5 years.
A 5-year carry forward helps. Are there income limits?
Yes, like many other credits, it begins to phase out for higher income taxpayers. For 2023, that phase out started for those with modified AGI over $239,230, and it was completely phased out above $279,230.
Okay, so aimed more at middle and lower incomes. What expenses qualify?
Eligible expenses include all reasonable and necessary adoption costs, court costs, attorney fees, traveling expenses, including meals and lodging while away from home, and other expenses directly related to the legal adoption of an eligible child.
What doesn't qualify?
It's important to note that it's not available for adopting your spouse's child. Also, costs related to surrogate parenting arrangements don't qualify, and medical expenses for the child are generally not considered adoption expenses for this credit.
Good distinctions. When do you claim it?
Generally, you claim it in the year after the expenses are paid or in the year the adoption becomes final for foreign adoptions. For domestic adoptions of children with special needs, you might be able to claim the maximum credit even if your expenses were less. It really acknowledges the significant financial commitment involved in adoption.
Definitely. Next, let's discuss the Retirement Savings Contributions Credit, often called the Saver's Credit. This sounds like a bonus for saving.
It really is. It's a powerful incentive for people to save for retirement, especially those with lower or moderate incomes. It's a non-refundable credit specifically designed for taxpayers who contribute to a qualified employer-sponsored retirement plan, like a 401k, or to a traditional or Roth IRA.
Okay, who's eligible?
To be eligible, you must be at least 18 years old, you cannot be claimed as a dependent on someone else's tax return, and you cannot have been a full-time student during the year.
18 plus, not a dependent, not a full-time student. Got it. How much is the credit?
The credit amount is either 10%, 20%, or 50% of your contribution. The maximum contribution that qualifies for the credit is $2,000 per taxpayer. $4,000 for married filing jointly, if both contribute.
10, 20, or 50%. What determines the rate?
The specific credit rate you receive depends directly on your adjusted gross income and your filing status. The lower your AGI, the higher the percentage.
Can you give an example?
Sure. For 2023, a single filer with AGI up to $21,750 got the top 50% rate. So if they contributed $2,000 to an IRA, they get a $1,000 credit.
Wow, a 50% return instantly from the credit.
Exactly. The rate drops to 20% for single AGIs between $21,751 and then to 10% for AGIs between $23,751 and $36,500. Above that, the credit disappears. The income bands are higher for head of household and married filing jointly.
So it's really targeted. Is there any carryover?
No, there's no carryover for this credit if you can't use it all in one year because your tax liability is too low. But it's still a direct reward for saving for your future when you can claim it.
Definitely an incentive not to miss if you qualify. Now, what about the foreign tax credit? This sounds like it's for individuals who might have worked overseas or invested internationally.
That's right. If you've paid income taxes to a foreign country or a U.S. possession on income that's also subject to U.S. tax, you generally have an option to avoid double taxation.
What's the option?
You can either claim these foreign taxes paid as a credit against your U.S. tax liability, or you can deduct them as an itemized deduction on Schedule A.
Credit or deduction, which is usually better.
Generally, taking the credit is more beneficial because, as we discussed, a credit reduces your tax liability dollar for dollar, whereas a deduction only reduces it by your marginal tax rate.
Makes sense. Is the credit limited?
Yes, there's a limit. You can't just claim an unlimited foreign tax credit. It's generally limited to the amount of U.S. tax attributable to your foreign source taxable income. It's basically capped so the credit doesn't offset U.S. tax on your U.S. income. There's a specific formula to calculate this limit.
Okay, a calculation involved. What if the foreign taxes paid exceed the limit?
That's where the carryover comes in. A very useful feature of this credit is that any disallowed credit due to the limit can be carried back 1 year and then carried forward for up to 10 years.
Back one, forward 10. That offers flexibility.
Exactly. It helps smooth out differences in timing or tax rates between countries over time.
We also have the general business credit and the work opportunity credit. These sound more tailored for employers, right?
They are indeed primarily for businesses and employers, designed to incentivize certain business activities or hiring practices. The general business credit isn't just one credit, it's actually an umbrella term for a whole collection of different business credits.
Like what?
Things like the investment credit for certain types of business property, the research credit for qualified research and development expenses, energy credits for businesses, and others. There's a limit on how much GBC you can take in 1 year based on your tax liability, but unused credits can generally be carried back 1 year and forward 20 years.
Back when? Forward 20 for GBC.
Okay.
And the work opportunity credit.
The Work Opportunity Credit, or WOTC, is one component of the General Business Credit. It provides an incentive for employers to hire individuals from certain targeted groups who have historically faced significant barriers to employment.
Such as?
Examples include certain qualified veterans, ex-felons, individuals receiving SNP benefits, food stamps, vocational rehabilitation referrals, long-term unemployment recipients, and others. The credit amount varies depending on the target group and how long the employee works for the business. These credits encourage specific economic activities and social goals by reducing a business's tax liability.
Got it. Now, for one of the most widely known and often most impactful credits for families, the child tax credit. This one has seen a lot of changes over the years, it feels like.
It certainly has, especially with temporary enhancements during the pandemic. But focusing on the rules generally in effect, particularly for 2018 through 2025 under current law, taxpayers can claim a $2,000 tax credit for each qualifying child.
$2,000 per child. Who is a qualifying child for this?
A qualifying child for the child tax credit must meet several tests. Key ones are they must be under the age of 17 at the end of the tax year.
Under 17. That's important.
Yes, 16 or younger all year. They must also be your son, daughter, stepchild, foster child, brother, sister, step-sibling, or a descendant of any of these, like a grandchild. They must not provide more than half of their own support, must live with you for more than half the year, with exceptions, and must be a U.S. citizen, national, or resident alien.
Okay, specific relationship, age, residency, and support tests. Are there income limits for the parents?
Yes, there's a phase-out for higher income taxpayers. The credit amount of $2,000 per child starts to gradually reduce or phase out if your modified adjusted gross income goes above certain thresholds. For 2023, those thresholds were $400,000 for married filing jointly and $200,000 for all other filing statuses: single, head of household, married filing separately.
400K MFJ, 200K others. How does the phase-out work?
The credit reduces by $50 for each $1,000, or fraction thereof, that your MGI exceeds the threshold amount.
Okay. What's crucial to understand for many families is the refundable aspect of this credit. It's not just about reducing your tax bill to zero, is it?
Absolutely not. This is a game changer for many families, especially those with lower or moderate incomes. A significant portion of the child tax credit is refundable, meaning that if the non-refundable part of your credit reduces your tax liability to zero, you might still be able to get some of the remaining credit back as a refund. This is sometimes called the Additional Child Tax Credit, or ACTC, but it's all part of the same calculation now.
How much is refundable?
For 2023, the maximum refundable amount per child was $1,600. It's calculated based on a formula, generally 15% of your earned income above $2,500, but capped at that $1,600 per child, and also capped by the overall $2,000 credit limit.
$1,600 refundable potential. That means direct cash for many families.
Exactly. It can be incredibly helpful for household budgets. It's also worth noting there's a related credit for dependents who don't qualify for the child tax credit, maybe because they're 17 or older or they're another relative, like a parent you support.
Right. What's that?
That's the credit for other dependents. It's worth $500 per qualifying dependent. However, this $500 credit is non-refundable. It's subject to the same income phase-outs as the child tax credit, 400K MMFJ, 200K others.
$500 non-refundable for other dependents. Good to know. Another incredibly important refundable credit, especially for low-income taxpayers, is the Earned Income Credit, EIC, sometimes called EITC. This one can be a real game changer.
It truly is. The EIC is specifically designed to provide tax relief and often a significant income boost to low and moderate income working individuals and families. It's one of the largest anti-poverty programs in the U.S.
Who qualifies? What are the key eligibility rules?
There are several rules. You must have earned income, as the name suggests. You must primarily live in the U.S. for more than half the year. You need to meet certain earned income and adjusted gross income thresholds, which vary depending on your filing status and the number of qualifying children you have. You also can't have too much investment income. For 2023, the limit was $11,000.
Okay, low earned income, low investment income, U.S. residency. What about age or children?
If you don't have any qualifying children, there are specific age requirements. You generally must be at least 25 years old, but under 65 at the end of the tax year. If you do have qualifying children, those age limits don't apply. If you're married, generally you must file a joint return to claim the EIC, though there are some exceptions for separated spouses.
What exactly counts as earned income for this credit? Is it just wages?
Earned income includes wages, salaries, tips, other taxable employee compensation, and net earnings from self-employment. If you have a net loss from self-employment, you have to subtract that. It does not include things like interest, dividends, Social Security benefits, unemployment benefits, alimony, or child support. And importantly, pension or annuity income doesn't count either.
So primarily income from working.
Exactly. And one key insight, as you said, often tested or misunderstood, is that this is a fully refundable credit. You can get the full amount back even if you paid no income tax during the year.
And do you always need a child to claim it? You mentioned rules for no children.
No, a qualifying child is definitely not a requirement to be eligible for the EIC. You can claim it if you meet the rules for workers without a qualifying child. However, if you do have one or more qualifying children, the earned income credit percentage and the maximum amount of earned income on which the credit is based are significantly higher.
So the credit gets much bigger with kids.
Much bigger. For 2023, the maximum EIC for someone with no children was $600. With one child, it jumped to $3,995. Two children, $6,604. Three or more children, $7,430.
Wow, those are significant amounts. What defines a qualifying child for EIC? Is it the same as the child tax credit?
It's similar, but not exactly the same, which is tricky. For EIC, a qualifying child must meet relationship, age, residency, and joint return tests. The relationship test is similar: son, daughter, stepchild, foster child, sibling, descendant. The residency test is also similar: live with you more than half the year. The age test is different. The child must be under 19 at the end of the year, or under 24 if a full-time student for at least 5 months of the year, or any age if permanently and totally disabled.
Under 19 or under 24 if student, or any age if disabled. That's different from the CTC's under 17 rule.
Exactly. And crucially for EIC, if the child is married, they generally can't file a joint return with their spouse unless it's only to claim a refund. Also, you generally cannot be a qualifying child of another person to claim the EIC for yourself.
Complex rules there. Let's run through a quick example. Karen is 26 years old, single, with no dependents. In 2023, she had a gross income of $12,000, all from her job. How much EIC can she claim?
Okay, Karen is 26, so she meets the age rule for no children, 2564. Her earned income is $12,000. For a single person with no dependents in 2023, the credit is calculated as 7.65% of earned income up to a maximum of $7,840 of income, giving a maximum possible credit of $600. $7,840, 7.65%.
Okay, max credit $600. Did she get that?
Not quite, because there's also a phase-out. The credit starts phasing out for single filers with no children when their earned income, or AGI, whichever is higher, exceeds $9,800.
Her income is $12,000, which is over $9,800.
Right. Her income is $2,200 over that phase-out threshold, $12,000, $9,800. The phase-out rate is also 7.65%. So we reduce the maximum credit, $600, by 7.65% of that excess income. $2,200, 7.65%, so let's call it $168,
So $600 minus $168.
gives Karen a final earned income credit of $432.
$432. And that's fully refundable for her.
Fully refundable, correct. Directly putting money back into her hands. Remember that investment income limit, too. If she had, say, $12,000 in investment income, she wouldn't be eligible for EIC at all, regardless of her earned income.
Good point. Beyond these specific credits, there are a couple of other key payments that are treated like credits, such as taxes withheld from your W-2 and excess FICA, Social Security tax withheld. How do these act as credits?
Well, any income taxes that are withheld from your paycheck by your employer throughout the year aren't technically a credit in the same way as the EIC or child tax credit, but they function similarly on your tax return. They represent payments you've already made towards your total tax liability for the year.
So it's just getting credit for what you already paid.
Exactly. When you file your return, you calculate your total tax liability, and then you subtract the total amount of federal income tax withheld, shown on your W-2s. If the total withheld exceeds your final tax liability, that's when you get a refund. It's essentially an overpayment you're getting back.
Makes sense. What about the excess Social Security tax?
This situation is a bit more specific. There's a maximum amount of earnings subject to Social Security tax each year, $160,200 for 2023. If you work for only one employer, they should automatically stop withholding Social Security tax once your earnings hit that limit.
Okay.
But if you have 2 or more employers during the year and your total combined earnings from all jobs exceed that annual maximum, it's possible that each employer withheld Social Security tax up to the limit on the wages they paid you, resulting in a total withholding across all jobs that's more than the legal maximum required for the year.
Because the employers don't coordinate.
Precisely. In that specific scenario, excess Social Security tax withheld due to having 2 or more employers, you can claim the excess amount withheld as a credit against your income tax on your Form 1040.
So you get it back that way. What if the excess was withheld by just one employer who made a mistake?
If the excess withholding was only from a single employer, you cannot claim it as a credit on your tax return. In that case, the employer is responsible for discovering the error and refunding the excess Social Security tax directly to you.
Okay, important distinction. Multiple employers means a tax credit. Single employer means get it back from them.
Correct.
Okay, let's unpack this for our small business owners and those looking to make their homes more energy efficient. Our sources also mention some important credits here, starting with the Small Employer Retirement Plan Startup Costs Credit. What's that about?
Yes. This is a great incentive designed to encourage small businesses to establish new retirement plans for their employees, helping them save for retirement.
Which businesses are eligible?
Eligible small businesses are generally those with no more than 100 employees who received at least $5,000 in compensation in the preceding year. The plan must also cover at least one employee who is not considered a highly compensated employee.
Okay, max 100 employees includes non-highly compensated folks. What costs qualify?
A credit helps offset the ordinary and necessary costs to actually set up and administer a new qualified retirement plan, like a 401k, simple IRA, or SEP IRA, and also the cost to educate employees about the new plan.
Setup, admin, education. How long is the credit available?
It's available for the first 3 years that the plan is in existence.
3 years. How much is the credit?
The credit amount calculation is a bit layered. For employers with 50 or fewer employees, it's the greater of 2 amounts. 1, $500, or 2, the lesser of $250 multiplied by the number of non-highly compensated employees eligible to participate in the plan, or $5,000. For employers with 51 to 100 employees, the credit is generally 50% of the qualified startup costs, up to similar limits. Recent legislation actually enhanced this, making it potentially 100% of costs up to $1,000 per employee for the smallest employers, under 50 employees. But let's stick to the general structure mentioned in the source for clarity. Let's use the example. Alice started a SEP IRA for herself and 2 employees. Startup costs were $1,200. Alice is not highly compensated.
Okay.
Based on the structure in the outline, let's recalculate. It says the amount is the greater of 100% of the first $1,000 costs. For 5,100 employees, it's 50%. The lesser of $250 per eligible non-highly compensated employee, or $5,000. Alice has 3 eligible participants, herself plus 2 employees, and fewer than 50 employees.
Right.
So option 1, 100% of the first $1,000 of her $1,200 costs $1,000.
Okay, $1,000 from option 1.
Option 2, The lesser of $250 by 3 employees equals $750 or $5,000. The lesser is $750.
$750 from option 2.
The credit is the greater of option 1, $1,000, or option 2, $750. So the greater amount is $1,000.
Alice gets a $1,000 credit. That covers most of her startup cost.
Exactly. It directly offsets the initial burden of setting up retirement benefits, making it much more affordable for small businesses. There's also potentially an additional credit for employer contributions for the first few years under recent law changes, but the startup cost credit itself is significant.
Good incentive. There's also a small business healthcare tax credit. How does that work?
Yes, this credit is designed to help certain small employers afford the cost of providing health insurance coverage to their employees. To be eligible, an employer generally must have fewer than 25 full-time equivalent employees, pay average annual wages below a certain inflation-adjusted amount, and importantly, contribute at least 50% towards the cost of employees' health insurance premiums under a qualifying arrangement, often purchased through the Small Business Health Options Program, SHOP marketplace.
Fewer than 25 FTEs, lower wages, pays at least half the premium. How much is the credit?
For eligible for-profit employers, the maximum credit is 50% of the premiums the employer paid. For eligible tax-exempt employers, the maximum credit is 35%.
50% or 35% of premiums paid. That could be substantial. Is it refundable?
It's generally non-refundable for for-profit businesses, meaning it can only reduce the tax they owe. However, for eligible tax-exempt organizations, the credit is refundable, so they can get it back even if they don't owe unrelated business income tax. It's claimed on Form 8941.
Interesting distinction for tax exempts. Okay, shifting to homeowners, what about residential energy credits? These have gained more attention lately, especially as we consider sustainable living.
They certainly have, and they were significantly enhanced by the Inflation Reduction Act recently. There are two main credits for homeowners. First is the Residential Clean Energy Credit.
Clean energy, like solar.
Exactly. This offers a substantial credit, generally 30%, for the installation costs of qualifying new clean energy property for your home. This includes things like solar panels for electricity, solar water heaters, wind turbines, geothermal heat pumps, and even battery storage technology installed in connection with these systems.
30% of the cost. Is there a dollar limit?
Generally, there's no dollar limit on the credit for most types of property under this clean energy credit except for fuel cell property. The 30% rate applies to property placed in service from 2022 through 2032, then it starts phasing down.
No limit on 30% for solar, wind, geothermal? That's huge.
It can be a very significant incentive. Then there's the second credit, the Energy Efficient Home Improvement Credit.
Home improvements, like windows or insulation.
Yes, this credit is for making qualified energy-efficient improvements to your existing home. Think new exterior doors, windows, skylights, insulation, air conditioners, furnaces, water heaters, and even home energy audits.
What's the credit amount here?
For improvements placed in service after December 31st, 2022, the credit is generally 30% of the qualified costs. However, unlike the clean energy credit, this one does have annual limits. The overall total limit for this credit in any given year is $1,200.
$1,200 annual limit.
Right. And there are also specific annual limits for certain types of property. For example, the credit for new windows is capped at $600 per year, and for new exterior doors, it's capped at $250 per door, up to $500 per door, up to $500 total per year. For heat pumps or biomass stoves, the limit can be higher, up to $2,000 per year.
So you need to track the limits per item and the overall $1,200 annual cap. This is a big change from before, right?
Huge change. Before 2023, the similar credit was much smaller, often only 10%, and subject to a lifetime limit of only $500 total. Now it's 30% with annual limits, making it much more appealing and rewarding ongoing investments in home energy efficiency.
Definitely more usable now. And for those looking to green up their commute, there are vehicle and fuel-related credits, like the Clean Vehicle Credit.
That's right. This is the credit for buying new or used electric vehicles, EVs, or certain plug-in hybrids. For new clean vehicles placed in service after December 31st, 2022, you could be eligible for a tax credit of up to $7,500.
Up to $7,500 for new. Are there restrictions?
Yes, several significant ones. The vehicle must meet final assembly requirements in North America. There are also restrictions based on the vehicle's battery component sourcing and critical mineral content, which determine if you get half the credit, $2,750, or the full credit, $7,500. There are also manufacturers' suggested retail price, MSRT limits, $80,000 for vans, SUVs, pickups, $55,000 for other vehicles. And finally, your modified AGI must be below certain thresholds, $300 KMFJ, $225K head of household, $150K single.
Well, lots of hoops. Assembly, battery parts, price cap, your income. What about used EVs?
There's also a credit for buying a previously owned clean vehicle. The credit is 30% of the sale price, up to a maximum credit of $4,000.
$4,000 max for used. What are the rules there?
The vehicle must be at least 2 years old, cost $25,000 or less, and be purchased from a licensed dealer. Again, there are income limits for the buyer, lower than for the new EV credit. $150K MFJ, $112 and $5K HOH, $75K single.
Lower income limits and price cap for used.
Okay. Additionally, related to fueling these vehicles, there's an alternative fuel refueling property credit.
For charging stations.
Exactly. This gives you a credit for installing alternative fuel vehicle refueling property at your home, primarily electric vehicle charging stations. The credit is generally 30% of the installation costs, with a maximum credit of $1,000 for property placed in service at your personal residence. This helps offset the cost of setting up home charging.
30% up to $1,000 for the home charger install. Good to know. Finally, the credit section, we have the premium tax credit, PTC. What is this one for?
The PTC is a refundable credit designed to help eligible low or moderate income individuals and families afford the premiums for health insurance purchased through a health insurance marketplace established under the Affordable Care Act.
So for marketplace insurance plans, how does it work?
Eligibility is based on having income within a certain range, typically between 100% and 400% of the federal poverty line, though those upper limits were temporarily removed for recent years. Not being eligible for affordable coverage through an employer or government plan, like Medicare or Medicaid, and meeting other requirements. The amount of the credit is calculated based on your income and the cost of benchmark health plans in your area.
And it helps lower premiums.
Yes, the unique aspect here is that you can choose to have the credit paid in advance directly to your insurance company throughout the year. This lowers your monthly premium payments immediately, making coverage more affordable month to month.
Paid in advance. Interesting. What happens at tax time?
At tax time, you reconcile the amount of advance premium tax credit you received with the actual amount you were eligible for based on your final income for the year. If you received too much advance credit, you might have to pay some back. If you received too little or didn't take any advance credit, you can claim the difference as a refundable credit on your tax return.
So you need to reconcile it.
It's a crucial credit for making health insurance affordable for millions.
Okay, let's unpack this by moving from proactive planning with credits to avoiding pitfalls. We've talked about all these different ways your income is taxed and how credits can reduce your bill, but how do you manage that throughout the year? This brings us to estimated taxes. Why do they matter so much?
Estimated taxes are crucial because the U.S. operates on a pay-as-you-go tax system. This means you're generally expected to pay most of your tax liability throughout the year as you earn income.
Not just once a year in April.
Exactly. For most employees, this happens automatically through payroll withholding from their job. But if you're self-employed, a freelancer, have significant investment income, retirement income, or other income not subject to withholding, you likely need to make quarterly estimated tax payments yourself.
Why? What happens if you don't?
If you don't pay enough tax throughout the year, either through withholding or estimated payments, you could face a surprise tax bill when you file your return. And potentially worse, the IRS can charge you penalties for underpayment of estimated tax.
Penalties. Nobody wants those. So who is generally required to make these estimated payments, and what's the minimum they need to pay to avoid a penalty?
You're generally required to make estimated quarterly tax payments if you expect to owe $1,000 or more in tax for the year after subtracting your withholding and any refundable credits.
Okay, if you expect to owe at least $1,000 at tax time.
Right. And to avoid the underpayment penalty, your total withholding plus your timely estimated tax payments for the year need to satisfy one of two main safe harbor rules. You need to pay at least 1, 90% of the tax to be shown on your current year's tax return, OR2. 100% of the tax shown on your prior year's tax return, if your prior year return covered all 12 months.
Whichever's less.
Generally, yes, you need to pay the lesser of 90% of the current year's tax or 100% of the prior year's tax. Using the prior year's tax is often easier because you know that number definitively.
The 100% of prior year rule sounds safest if your income is stable or rising.
It often is. However, there's a notable exception or modification for higher income earners. If your adjusted gross income in the prior year was over $150,000, $75,000 if married filing separately,
Okay, higher income.
then the second safe harbor rule changes. Instead of 100% of the prior year's tax, you need to pay at least 110% of your prior year's tax liability to avoid the penalty using that method. The 90% of current year tax rule still applies as an alternative.
110% for higher earners using the prior year safe harbor. Good to know. And what happens if you fail to pay enough estimated taxes by the deadlines? Is there always a penalty?
A penalty may be assessed for underpayment. The penalty is calculated based on the amount of the underpayment, the period it was underpaid, and the applicable interest rate for that period. However, you generally won't face an underpayment penalty if the total balance of tax you owe when you file your return is less than $1,000.
Under $1,000 due at filing, no penalty.
Right. The IRS also has provisions to waive the penalty in certain specific circumstances, such as if the failure to pay was the result of a casualty, a disaster, or other unusual circumstance where imposing the penalty would be inequitable. It can also sometimes be waived for reasonable cause if you retired after age 62 or became disabled during the tax year or the preceding year.
So some limited exceptions. Is there a way to fix an estimated tax shortfall late in the year? Say, if someone realizes in November or December they haven't paid enough throughout the year.
Yes, there's a crucial strategy, particularly for people who also have wage income subject to withholding. If you realize toward the end of the tax year that your estimated payments have been insufficient to meet the safe harbor requirements and avoid a penalty,
Yeah.
you can often mitigate or even eliminate that potential penalty by increasing your federal income tax withholding from your wages for the remainder of the year.
How does that help with the quarterly deadlines you might have already missed?
Here's the key. The IRS treats income tax withheld from wages as if it were paid evenly throughout the entire year, regardless of when it was actually withheld during the year.
Even if you ramp it up in December.
Exactly. So a significant increase in withholding in November or December, for instance, can be effectively spread back across the earlier quarters for penalty calculation purposes. This can cover shortfalls from earlier in the year and potentially save you from an underpayment penalty. This requires submitting a revised Form W-4 to your employer to request the additional withholding.
That's a really useful tip for those with W-2 jobs.
It can be a lifesaver for avoiding penalties if you catch the shortfall late.
Okay. Beyond income tax and estimated payments, there are a few other important taxes that can impact your overall financial picture, often showing up on your Form 1040. Let's touch on self-employment tax.
Right. If you work for yourself as a sole proprietor, independent contractor, freelancer, gig worker, or partner in a partnership, you generally have to pay self-employment tax in addition to your regular income tax.
What is self-employment tax?
It's essentially your contribution to Social Security and Medicare. When you're an employee, your employer pays half of these FICA taxes, that's the Federal Insurance Contributions Act covering Social Security and Medicare, and you pay the other half through payroll withholding.
The 7.65% each, usually.
Exactly. When you're self-employed, you're considered both the employer and the employee, so you're responsible for paying both portions yourself. That totals 15.3%. 12.4% for Social Security up to the annual limit, plus 2.9% for Medicare with no limit on your net earnings from self-employment.
15.3%. That's a big chunk. How is it calculated and paid?
It's calculated on Schedule SE based on your net profit from your business or self-employment activities. Generally, it applies if your net earnings from self-employment are $400 or more. 100% of this calculated self-employment tax is then added as an other tax on your Form 1040.
Added to your income tax liability. Ouch. Is there any relief?
Yes, there's a very important adjustment. To recognize that you're paying both the employer and employee halves, you get to deduct 1/2 of your calculated self-employment tax as an adjustment to income when figuring your adjusted gross income, AGI.
An above-the-line deduction for half of it.
Correct. This deduction helps offset the burden of the employer portion you're paying. So while the tax rate seems high, this deduction effectively makes the net cost more comparable to what employees experience.
That's crucial for self-employed folks to remember. What about the additional Medicare tax? This sounds like it affects higher earners.
It does. This is an extra layer of Medicare tax, specifically 0.9%, imposed on wages, self-employment income, and certain railroad retirement compensation that exceeds specific thresholds based on your filing status.
I have 0.9% extra. What are the thresholds?
For married couples filing jointly, it applies to combined wage income over $250,000. For married individuals filing separately, the threshold is $125,000. And
So 250K MFJ, 125K MFS, $200 others. How is it paid?
For wage earners, employers are responsible for withholding this additional 0.9% Medicare tax on employee wages that exceed $200,000 in a calendar year, regardless of the employee's filing status or wages from other jobs.
The employer withholds it based on just their wages paid over $200.
Correct. This might lead to situations where it's underwithheld if you have multiple jobs pushing you over the filing status threshold, or overwithheld if your spouse also has high income. Self-employed individuals factor into their estimated tax payments. Any additional tax due is paid with your Form 1040. If too much was withheld by employers, you can claim the excess withholding as a credit on your return.
Okay, adds another layer for higher earners. Then there's the net investment income, NII, tax, sometimes called the NIIT. This sounds like it targets certain types of income, again, for higher earners.
It certainly does. The net investment income tax, or NIT, was also introduced as part of the Affordable Care Act. It implies a 3.8% tax rate specifically to certain net investment income for individuals, estates, and trusts whose income exceeds specific statutory thresholds.
3.8% on investment income. What are the income thresholds for individuals?
The thresholds are based on your modified adjusted gross income, MAGI. The tax applies if your MAGI is above $250,000 for married filing jointly or qualifying widowers, $125,000 for married filing separately, and $200,000 for single or head of household filers.
Same thresholds as the additional Medicare tax, except for MFS.
Exactly the same thresholds: 250K MFJ, 125K MFS, 200K others.
How is the tax calculated? Is it 3.8% of all investment income once you're over the threshold?
Not quite. The 3.8% tax is imposed on the lesser of two amounts. One, your total net investment income for the year, or two, the amount by which your MGI exceeds the applicable threshold, 250K, 125K, 200K.
The lesser of NII or the excess MEGI. Okay. What kind of income falls under net investment income?
Generally, net investment income, NII, includes taxable interest, dividends, including qualified dividends, non-qualified annuities, rents, royalties, net capital gains, both short-term and long-term, and income from passive business activities or businesses involved in trading financial instruments or commodities.
So typical investment portfolio income, rental income, passive business income.
Pretty much. It does not include wages, self-employment income, which are subject to FICA Medicare, tax-exempt interests like from municipal bonds, veterans benefits, or distributions from most qualified retirement plans like 401ks and traditional IRAs, though Roth conversion income might be included.
Okay. Can you deduct expenses against this income?
Yes. NII is calculated net of certain deductible expenses that are properly allocable to that investment income. This can include things like investment interest expense, investment advisory and brokerage fees, expenses related to rental and royalty income, and state and local income taxes allocable to NII items.
So you calculate the net amount first.
Correct. This tax is specifically designed to ensure that certain higher income individuals contribute more from their investment earnings, primarily towards funding Medicare.
Let's consider Susie again. She's single, her AGI is $210,000, which we'll assume is her NGI too. Her income includes $400 in taxable interest, $500 in qualified dividends, and $10,000 in net rental income. How would her net investment income tax be calculated, and how does it fit into her total tax picture?
Okay, Susie is single, and her NGI of $210,000 is above the $200,000 threshold for single filers.
Right, she's $10,000 over the threshold.
First, we calculate her net investment income, NII. That's the interest. $400 plus qualified dividends, $500 plus net rental income, $10,000, $11,900 total NII. Wait, the outline says $10,900 NII. Let's use that for consistency with the example numbers provided. Okay, so Susie's NII is $10,900.
NII is $10,900. Excess MAGI over threshold is $10,000.
Correct. $200,000, $200,000, $10,000. The NIIT is 3.8% of the lesser of her NII, $10,900, or her excess MAGI, $10,000.
Her lesser is $10,000.
Right. So her NII is 3.8% multiplied by $10,000, which equals $380.
$380 NIT. And this is in addition to a regular income tax.
Yes, exactly. It's an additional tax calculated on Form 8960 and added to her total tax liability on Form 1040. So if a regular income tax calculation, considering ordinary income and the preferential 15% rate on her $500 qualified dividends, resulted in, say, $39,547 of tax liability before NIIT.
Based on the outline's numbers, her ordinary income tax was $39,472, and the tax on dividends was $75. So $39,547 total before NIT.
Okay, using those numbers. $39,472 ordinary tax plus $75 preferential tax on dividends plus $380 NIT equals $39,927. That's her total tax liability.
$39,927. This example beautifully shows how these different layers of taxation, ordinary rates, preferential rates, and the NII tax come together for a single taxpayer.
It really does illustrate the multi-layered nature of the system, especially for those with higher incomes or investment income.
That's a comprehensive breakdown. And finally, one more other tax that often catches parents by surprise, or at least causes them to scratch their heads, the kiddie tax. What's the purpose here?
The kiddie tax exists for a very specific reason: to prevent high-income parents from shifting their unearned investment income, like interest, dividends, capital gains, to their children, who are presumably in much lower tax brackets, simply to avoid paying tax at the parents' higher rates.
So it stops parents from using kids' low rates for investment income. Who does it apply to?
It generally applies to a child who has unearned income over a certain threshold, $2,500 for 2023, and meets certain age requirements. Specifically, it applies if the child is under age 18 at the end of the tax year,
Under 18.
or if the child is age 18 at the end of the year, or age 1923 if they're a full-time student, and in both cases, their own earned income from working does not exceed half of their total support for the year.
So under 18, automatically if they have enough unearned income, or 1823 if a student, and not supporting themselves primarily through work.
Exactly. And they must also be required to file a tax return and have at least one living parent at the end of the year.
Okay. How is the tax actually calculated? Does the child pay tax at the parent's rate on all their investment income?
Not quite all of it. First, the child gets a small threshold amount of unearned income that is taxed favorably. For 2023, the first $1,250 of unearned income was typically offset by the child's standard deduction, if they had no earned income, resulting in zero tax. The next $1,250 was taxed at the child's own ordinary income tax rate, usually 10%.
So the first $2,500 gets preferential treatment. $0 tax on first $1,250, child's rate on next $1,250.
Correct. It's the child's unearned income over that $2,500 threshold that is subject to the kiddie tax. That excess unearned income is taxed at the parent's marginal tax rate, or rates if it spans multiple brackets, as if the parent had received that income directly.
Taxed at the parent's rate. That's the kiddie part. How is this reported?
It's calculated using Form 8615, Tax for Certain Children Who Have Unearned Income, which is filed with the child's tax return. The child still files their own return, but this form calculates the extra tax based on the parent's rates.
Okay. Is there any way to simplify this?
There is an option for parents in some cases. Parents can elect to include their child's unearned income directly on the parent's own tax return instead of filing a separate return and Form 8615 for the child. This election is made using Form 8814.
When can parents make that election?
It's available only if the child's only income is interest, dividends, and capital gains distributions, and if that gross unearned income is more than $1,250 but less than $12,500 for 2023. There are other requirements too, like the child being under age 19 or 24 if a student. Choosing this election might result in slightly more tax in some cases, but it simplifies the filing process by avoiding a separate return for the child.
Simpler, but maybe slightly more tax, a trade-off to consider.
Exactly. The kiddie tax rules ensure that significant investment income earned by children is taxed similarly to how it would be if the parents earned it directly.
Wow, we've covered a tremendous amount of ground today. So what does this all mean for you? We've gone through the progressive nature of ordinary income tax, the different tax brackets for various filing statuses, and how preferential rates apply to certain types of income like long-term capital gains.
This is the foundational pieces.
We've decoded the incredible power of tax credits, distinguishing between those non-refundable ones that just reduce your bill to zero,
like the lifetime learning credit or adoption credit,
and those amazing refundable credits like the EIC and parts of the child tax credit that can actually put cash back in your pocket.
Yeah, real money back, yeah.
And we've highlighted the importance of estimated payments to stay on track throughout the year and avoid penalties, along with understanding those other taxes that can layer on top, like self-employment tax, the net investment income tax, and even the kiddie tax.
It's a lot of interconnected parts.
It really is. It's clear that understanding tax computations and credits isn't just for accountants. It's absolutely vital for your personal financial health and planning.
Absolutely. And, listening to all this, it raises an important question, I think. Considering the complexity we've just discussed and the numerous opportunities embedded within the tax code, from basic income computation nuances to this vast array of credits and special taxes, how can individuals proactively identify and leverage these insights? How do you move beyond just ensuring compliance once a year to actually optimizing your financial situation using this knowledge?
That's a great point. It's not just about April 15th.
Not at all. It really speaks to the fact that the tax landscape is always evolving. Laws change, interpretations shift, new credits appear, old ones expire. Making continuous education about taxes and maintaining an informed approach throughout the year becomes a really powerful tool for your overall financial well-being. It's about planning and making informed decisions as life happens, not just reacting at tax time.
That's a perfect thought to leave you with. Knowledge truly is power, especially when it comes to your money and navigating this system. Thank you so much for joining us on this deep dive into decoding your dollars.
Thanks for having me.
We hope you've gained a clearer understanding of how these pieces fit together and feel more confident navigating your own financial landscape. Go forth and apply this knowledge.